Erica with Fairway Mortgage, thank you for being here today and kind of going over some credit basics. So, I've been in the business for a long time, but like credit scores are one of those things that frustrate me so bad because I feel like you in your mind can be doing all the right things, but then it doesn't have the impact that you think it should or that it's going to. So
right. It's kind of a loose cannon, and things are changing constantly. I just found out one thing today that I've known to be true is that when you get added as an authorized user on somebody's card, that can be a quick fix for somebody that doesn't have credit history. So this is just an example of something talking about how quickly things change. But we just found out today that they have changed the algorithm that, if husband, kids, whoever does not have a very good score, have very much credit history, mom, wife, somebody could add them as an authorized user, and that credit would show up with that history. So what I found out today that yes, that card starts reporting the next month, but they have made it to where it does not affect the authorized user's score for 6 months now. So it's no longer a quick fix for somebody that doesn't have history. So it's just an example of how quickly things change. But so we're definitely not the credit experts either, but we have things like this information to help people just get an idea of what affects your credit and where you need to focus if you're trying to get your scores up.
Mm-hmm. So that brings up a good point. I mean, for a mortgage, first of all, why is credit scoring for a mortgage different than when you apply for, say, a credit card or whatever?
The biggest reason is the investors, it's where the money's coming from. So it's not who you make your payments to, but the wholesale lines of credit that lenders use, which are mainly 40% of our money comes from US Bank and Chase. So those are our lines of credit. They're the ones that require the higher scores because they're the ones that are giving up $300,000. If you get a $10,000 credit card, that's not $300,000. It's also something that's revolving. Mm-hmm. So even if you use that 10 grand and pay it down or max it out, you're still maxed out at 10,000 and the interest rate is much higher. And that's where they get you. But if they're going to give you $300,000 at 3%, they don't start making money on that for 3 years.
Oh, wow.
You have to pay your mortgage for 3 years before Chase or US Bank or whoever the initial warehouse line of credit is. They don't start making money until 3 years. So they want to make sure that they're loaning that money to people that have utilized other credit given to them, well.
Mm-hmm.
But that's why also when you pull your credit for a car or a home, why it's considered a hard pull instead of a soft pull is because they're dinging you as like the worst possible case of your credit to make sure you still have a good score after that hard pull.
Okay.
Yeah.
So let's talk about how credit scores are determined with this screen share here.
Yeah, so right along the left side, you can see that the number one thing is payment history. The thing that a lot of people don't understand when I pull credit and I say, oh, you had this 30-day late on your credit card or you have this small medical collection, those hurt your score so much, possibly up to 100 points. But you're not going to improve your score unless you get that collection removed. Just paying it off most likely won't improve your score. Or you go 6 months of positive history with something you've been late on. So even if you were just 30 days late on a car and you lose 100 points to your score, it's going to take 6 months plus for you to gain that back.
Oof.
Yeah, because the positive history improves your score, but as soon as you have a mark against it, that drop is really hard to get back quickly. The biggest thing in that payment history is credit cards, and it takes it down to the next one, amount owed. Too many credit cards with high balances can lower a score. So say that you have 3 credit cards and one of them is maxed out and the other 2 you don't have a balance on. That is going to be worse to your score than saying a small balance on each of them. You want to have more non-used credit than used. But then the other thing that can happen that's a good trick for people is, let's say you were late on your car and you have all these credit cards that have balances on them. Paying those down is going to increase your score a lot faster than just waiting for the positive payments to fix the car late. So revolving credit cards, revolving debt is a very quick fix to lower credit scores if people have the ability to pay them off, or even to spread out that debt a little bit. Like if you get the 0% checks in the mail to transfer a balance, if you just even out that debt, that will help your score a lot.
Okay.
So payment history and then amount owed on the credit cards are the 2 top ones.
Okay. So, so when you were saying, like, if you have a 30-day late, for instance, and it affects you for 6 months, so there's nothing that you can do about that? I mean, you
can try to get the creditor to remove it. If there's a reason it was late, I work with a lot of African borrowers, and they may leave the country to go home for 3 months, and they think they have something set up, or they think they've paid it, and they get back and they had a 30-day late. So sometimes if you have a good creditor that you're working with, you can show them you were out of the country and it was just an honest mistake, and they may remove that 30-day late. Now, if you're working with Wells Fargo, they're not removing it. They're just not. You could have been in the hospital. They don't care. They do not remove lates. Sometimes you can pay a credit company to come in and do the work for you. But they will tell you that if it was a legitimate late, then they may not get it removed. But if you can actually get a late removed or get a collection removed, your score will shoot back up that 100 points, if that's how far it goes.
Okay. So I guess, what are some of the best things that you can do to boost your score?
Revolving credit. So using and paying down the credit cards. So if you have a credit card with $1,000 max up to $10,000, you just want to use 30% of it and then pay it down, but you don't pay it off. You only pay it down. You keep 75 to $100 on it every month, and then use it again and pay it down. You just have to be sure you're doing it within your budget, that you're not just buying everything to rack it up that you won't be able to pay it down. Just use your regular expenses of groceries and gas. And I pay all of our bills on a miles card, to get the miles, and then pay it down.
But you're saying don't pay it off.
Don't pay it off. You want to keep a very small balance on it.
Okay.
Sometimes when you pay it off, if it reports that, so if you pay it off before it reports the next time, and you don't have anything, you didn't leave a balance on there, it's going to not report any activity.
Okay.
You want it to report every month that you've had activity, that it has seen it go up, and then it has seen it come down and go back up.
Anne has a question here, so I'm going to unmute you. Anne, go ahead.
Yeah.
So my question is about credit cards, because I don't really use credit for anything, and I have a really high credit score, but I mean, it's like over 800. But that's exactly what I do. I use my credit card for everything. If I go to the dollar store, I use my credit card. But I pay it off every 2 weeks. I pay off the whole thing. Should I not do that?
Well, if you're maintaining that high of a credit score, you're fine. You're fine to do that. And if you're paying it off where it's still possibly showing activity when it reports, it still could be. So if your credit card statement goes from May 25th to June 25th,
Yeah.
long as if it's showing that there's something on there June 25th when it sends out your statement, it shows activity.
Okay.
So sometimes we'll have people that don't use credit like you, and their score has dropped because of like some random collection or something. And we actually just had this happen. And we put him in credit repair, and they said, you have to use one of these credit cards. And God love him, he does not like to keep credit card
I don't
debt.
either.
Yeah.
Yeah, I don't either.
So she said, you have to use the credit card and you have to let it cycle, and then you can pay it off. Well, he used it and he paid it off 2 days later.
No.
It cycled. It didn't show the activity that he used, and his score didn't go up because you have to. So if you're using it for everything and paying it off every 2 weeks, you still could hit on your statement end date that there's some sort of balance.
Okay. Yeah, that's probably true.
It sees it. Yeah.
Okay, was that it, Ann?
No, I have one other question. So when I retired, I did pull a credit report because over the years we've had a lot of accounts. And so I went through the credit report line by line. It was like 20 pages long.
Wow.
So that there are a lot of accounts that show closed. Now, do I need to somehow try to get those off my credit report?
No, because that's still your history, and
Okay.
probably eventually drop off.
Okay.
Yeah, but no, it's fine to have those on there.
Okay. Because I look at my credit stuff, my credit report at least every quarter. But I look at my credit cards every day to make sure there's no fraudulent charges on there.
That's awesome. If you're hovering 800 plus, you're golden. You know.
Yeah. Well, I mean, that's all well and good, except I don't need to borrow any money, but yeah.
Right. But if you do see some, I mean, obviously you monitor it. So if suddenly you're at a 740, then that's where you get it, get it really checked, or pull your credit report so that you can see what happened.
Yeah.
Now, I know annualcreditreport.com is a good way to do that, but that means you can only pull it once a year, right?
Yeah. And, I tell people to do that. Make sure you do it every year. And we also tell them to follow Credit Karma, because you don't get your scores, but so far it's very accurate. I think the scores, when the people that do get the scores, they're not right.
No, they're way off. It's really weird.
Yeah, but usually the balances, the lates, anything like that are correct.
Okay. So sign up for Credit Karma and do the annual credit report at least once a year.
Yeah, and because too, sometimes we just had this scenario. Somebody only tracked their Equifax. And when we pulled her credit, there was a collection from a doctor only reporting to TransUnion. So she thought, following Equifax, she saw that doctor bill hit Equifax as a collection, and she disputed it. It was sent to the wrong person from the doctors, and she disputed it. I mean, they put it on her credit, but it was supposed to go to a different person. And so she disputed it with Equifax, and they removed it. But when we pulled her credit, it was still reporting on TransUnion. So where she thought, according to Equifax, she had a 780 score, we saw 675.
Ooh.
And so we had to then dispute it with TransUnion. So, it just caused a little hiccup that nobody really knew because she only monitored one credit bureau. So it's best to do Credit Karma and your annual so that you can see what's happening on all 3 credit bureaus.
Okay. And did you have another question on that?
Yeah, so this is so petty. This is so minor. But 2 months ago, I got a toll bill for my son, who's been dead for 4 years.
Oh, wow.
So I called them and said, this is not possible. He's gone. The car's been sold for 3 years. And they were like, pay it or we're going to sue you. And I'm like, you can't sue someone who's not here anymore.
Right.
So, and they were like incredibly hateful about it. So I talked to my daughter and advised me if this is the wrong thing to do. I mean, the bill's not in my name. It's not my car. My name's not on the car.
Yeah.
So she said, just ignore it. So I did. But then I got it again this month and I just threw it in the trash.
And so he just was at your address. That's why it's
Yes.
your
Yeah,
address?
his car was registered to this address.
Yeah, I wouldn't pay it.
Well, I mean, I know it sounds like such a stupid thing, but I'm very sensitive about things like that. And
Yeah, it's not your bill.
yeah.
So,
Mm-hmm.
yeah, I would just, it's not your bill and he doesn't live there and yeah, the car's gone. So
I don't know how this guy that bought the car is still driving around with his license plates. I mean, those plates have to be expired.
That's weird.
he might have had the little transponder thing in the windshield.
He didn't.
He didn't. It really was the plates. Wow.
Yeah.
All right. Well,
okay.
We'll get back to the credit stuff.
So those are the top 2: payment history and amount owed. Sorry, did you have something?
Oh, no, that's okay. No, I was just going through on, building favorable scores and things that you can do. So we talked about, not paying your balances all the way down, leaving a little bit there every month.
Mm-hmm.
What about this, the point that says don't co-sign on loans? What's the deal with that?
Well, I mean, that's just,
Co-signer is late?
Yeah. Well, just if they don't pay, it's on you.
Right.
So, that's just the main thing with that. I mean, you can if you want to, but it's,
now, when you're a co-signer, because I do have this situation a lot, Erica, where, say for instance, somebody co-signed on their brother's car loan or something, does that count against them when they go to buy a house? Are they showing as responsible for that debt?
It does. And also if parents co-sign on a kid's home, what you can do is the only way you can exclude that debt that you co-signed on in your debt to income is to prove that the person you co-signed for has paid that debt for the last 12 months. I mean, even if it's 11 months, it's not going to work. I just had one where I asked for an exception for 10 months and they said no. It has to be 12 months and you have to show the canceled checks in the person's name, that you co-signed for. It can't be cash payments, there has to be proof.
Okay. So if I co-signed on my son's car loan, then I would have to show 12 months of statements of that payment coming out of his account. Otherwise it counts against me.
Exactly.
Okay.
Yeah. Any co-signed debt, whether it's a house, anything that shows up on the credit, that it's got to be that 12 months.
Okay. And then this says don't close old revolving accounts that are no longer in use. So even though you're not using something, you don't want to close those accounts.
Right. Now, when you have 20 pages of them, like Anne, you can close some of them because that will help reduce the risk of fraud and identity theft. But if you're trying to build your score, and you maybe, like for me, I have old credit cards that I don't close just because they were my first cards and they're my history. Mm-hmm. Even now I've gotten to the point where I have rewards cards that I didn't have before. So I only use my rewards cards, but I keep the old ones open because as you'll see back on the left, length of credit history is 15% of your score. So it's a big chunk. And if you start closing the old cards, the algorithm just says, take away that history and it'll affect your score.
Okay. And then opening new accounts. So, I mean, obviously, this is something from the real estate side of things that I always think about and talk to my clients about when they go under contract. You know, definitely don't go to American Furniture and open a new line of credit. Don't buy that new car until after closing.
Right. That's the big one.
But are you saying, like, if somebody is thinking about buying in 6 months or a year, like at what point should they not open any new accounts?
So that's a hard one, because like it says below, the inquiry may or may not affect your score. If it's a credit card, it's not going to affect your score that much. And if you're just like, wow, I've got to get this, tooth taken out and I need the CARES credit, that's fine. You can go ahead and do that. If you see, if you get an upgrade to your credit card in order to get a miles bonus, go ahead. But if you're going to buy in 6 months to a year, a new car will not only affect your credit score because it's a hard pull, it will also affect your debt to income. So it's better as a buyer to talk to a mortgage professional before buying big ticket items like that, or depreciating items like RVs or motorcycles or boats, just to make sure it doesn't affect your ability to purchase in that next year.
Okay. So another big one, credit card fraud, identity theft, all of that is huge, I feel like, right now. So if you do see something weird on your annual credit report or Credit Karma or whatever, like, what should you do?
So at the end of the report, there will be phone numbers for all 3 credit bureaus. And I would just call them and let them know you suspect fraud so they can put freezes on right away. And then also investigate it so they can find out what, what to do and what you can have taken off and fixed.
I've also heard that you can actually call them and put a freeze on your accounts before, like, even if you're good right now, just so that no one can pull new lines of credit. Or, I mean, it's kind of a pain though, because if you do go to apply for a credit card or something, you have to call them and be like,
yeah. And it's very easy to put a freeze on. It's a little bit tougher to get it off because they may or may not ask you to create a PIN number when you do your freeze, and most people forget the PIN by the time they need to unfreeze. Have to mail you the PIN. They won't tell you. You have to call them, and they ask you all these questions that, just like when you go like on the IRS to get your transcripts, they ask you all these questions that may or may not be true for you personally, and they identify you, and then they mail you through the post office your PIN number. So if you do put a freeze on and they ask you for a PIN, just make sure you remember it.
Yeah. Okay, so I had another question here in looking at having a healthy mix of credit. What's the difference between installment loans and then revolving accounts with balances?
Yep. So installment loans are fixed loans. So a car, a student loan, your furniture at American Warehouse, those are a set amount at a set interest rate with a set payment. So it's just, you get that loan and you pay it back according to those terms. But the revolving accounts are just credit cards or home equity lines of credit, because you can continually use it. It's always revolving. You pay it down, you build it up. So that's why it's saying the installment loans, you just start that payment until you pay it off. The longer you've paid on it, the better it helps your credit. So if you get a car, it might ding your credit a little bit at first, but after you've paid it for 6 months and they see you're utilizing it correctly, then your score will bounce back.
Okay.
And then the revolving are your credit cards with balances. And then again, on the revolving, keep it below 30% of the high credit max. So if you have $1,000 credit try to keep it 300 or less, build it up to 3, pay it down, so that whenever it reports, you keep your score high.
Okay. Okay, cool. Anything else that would be good for like Allison to know about, what to know about credit when buying a house down the road?
Well, there's one thing I want, yes, for her to know and for you, because this is a big myth in our industry, is that when a lender pulls your credit, that you have 14 days to have that credit pulled by multiple lenders, and everybody gets the same score so that you can shop for a mortgage. That is not true. So and this is why, and if I pull somebody's credit today and I get a 740 and they wait 2 days to have another lender pull it, something could have reported in that 2 days. Every day our credit changes. So the other thing is they could use, where I use Advantage Credit, they could use, another credit company. So the only way we're guaranteed to get the same score is if I pull credit on Monday, and on Wednesday when another company pulls credit, they use the same company that I use and nothing has reported to the credit in the last 2 days. It's just not, there's no magic within the polling system that gives people the exact same score for 14 days. It's not going to happen. And every time you pull is a new inquiry.
Mm-hmm.
It may not be as hard of a hit to pull it 2 days later because it just got pulled, but it will show up as another inquiry on your credit.
Mm-hmm. Yeah, that has been a big myth that's gone on for a long time.
Long time, yeah. Well, and it's what I was told, so it's what I shared. And then I finally went to like a credit weekend seminar where I learned way more than I ever wanted to know, and they debunked that myth. And I was like, oh, well, that makes perfect sense, because I know if I check my credit today on Wells Fargo and tomorrow on Capital One, they're not going to give me the same score.
No.
So why would 2 different mortgage companies, when they have their own dates and their own times and their own credit companies, it made perfect sense to me that you're not going to get the same score.
So, I mean, I know you don't like to hear this, but when a prospective buyer is shopping lenders, what should they do then?
Well, they just have to be aware that it very well could affect their score.
Mm-hmm.
If they're borderline, like if they come to me and they say, I don't know if I want you to pull my credit because I want to talk to 3 lenders and I think I'm at a 680 according to Wells Fargo, what I tell them is go pull Credit Karma, bring it to me, I'll manually enter debts, we'll get your income exact. You talk to all 3 lenders and figure out who you want to work with and who you trust and you like and is giving you the best service. Have that lender pull your credit.
Mm-hmm.
If you're at an 800, it's not going to affect you enough to really, you can shop and have 3 lenders pull your credit. But if you're borderline where it's going to make or break your rate and PMI or going FHA to conventional, and I know somebody's shopping, I tell them, go bring me this information and let's manually look at it and just price it as a 680. And then when you're comfortable with one of these lenders, have that lender pull your credit.
Okay. And just to kind of recap, like, what's the ideal goal for a first-time home buyer as far as credit scores to be able to kind of get the best pricing? Is it 7 to have their median score, meaning TransUnion, Equifax, and Experian? You take the middle score of those 3. Does that middle score need to be above 740 ideally?
Well, 700 will get you into conventional lending with a decent PMI rate. Because what happens when you get below 700 is the private mortgage insurance becomes more expensive than FHA's. So that's kind of where you flip from going conventional to FHA is below 700.
Okay.
So yeah, 740 is great, and you'll get even a better rate on PMI, which just watching, you know, private mortgage insurance is required when you put down less than 20%. But if you know, have a 700 versus a 720, you'll probably still roughly get the same interest rate, but it does affect your PMI rate.
Okay.
Say 700 is the line between conventional and FHA.
Okay. Okay. And then we just have some definitions here, why your credit scores may differ. I think we talked a little bit about this as far as different models, different reporting companies, etc. Oh, and that's just a copy of that, I think. So anything else that you think would be really good for people to know about credit scores, or if anybody else has any more questions on anything, or, you know, maybe a situation that you've personally run into?
I'm trying to think here. The biggest thing that pops up are that people just don't know about and understand how detrimental they are medical collections. And even though supposedly last year they made it where medical collections don't affect your score, we've seen people get pre-approved, under contract, do the credit refresh, and a medical collection has shown up. When that happens, so when we do a credit refresh right before closing, that's mainly just to see if they got the American Furniture card, if they bought a car. It just pulls inquiries and balances. So if they've had an inquiry, you know, then you have a little bit more extra paperwork. Did you open an account? We need to know the balance, blah, blah, blah. If a collection has popped up, it's at that time underwriter's discretion to pull a brand new report. And we have seen so many people get bopped. I had a 720 borrower that had an $85 medical collection show up in the credit refresh 5 days before closing, and she went from 720 to 680. And so then she had to buy down her rate to keep the rate, you know.
What a nightmare. Over $85.
Over $85. And it's just, if you know, to those out there that do have medicines or have to go to the doctor or have co-pays, really stay on top of that to make sure there's no surprises there later.
Mm-hmm.
I think that's my biggest.
Okay. Is the medical.
Yeah, and spread out your use of credit cards. Like if you have a big expense, car breaks down or whatever, and you need to throw $1,000 on a card, then use a different card, you know, for your gas that week. Like try not to just rack up one card when you have 3 or 4 to use.
Mm-hmm.
Yeah.
Okay. Yeah, it's tough because, you know, on one hand, I really like Dave Ramsey type of thinking of not having any credit, ideally, but, you know, in the world of mortgages, you kind of have to. So
You do. Yeah, I know. I like that too. And it took me a long time to get to that balance of not overspending, of still, you know, I like Dave Ramsey too. And we did the cash envelope for a long time just to see where the heck is our money going, you know?
Right.
And we had a lot of credit card debt from our adoption. So we were drowning, you know, for a few years in credit card debt. And so we did the Dave Ramsey thing and we got it all paid off. But now it is, you really have to just watch those balances and make sure you're not living outside your means.
Well, very good. Well, thank you so much, Erica. Does anybody have anything else or any other questions? Allison? Oh, sorry. I unmuted you and then.
I was like, am I muted? I don't know if it's me. Yeah. I had a question regarding, I'm looking to purchase either on my own or with a partner next year, and his credit score is not the best. So I was wondering, is it better to like have it be kind of like under me, or how does it work when you have two people that are buying a property together that maybe aren't married yet, or like just how that would work for applying?
Yep. So we do use the lower of the two borrowers' middle score for qualifying. So if you bought together, then we would use his score if it's not as good as yours. We have a couple of options. If he's going to be paying the mortgage and contributing to the down payment, but you just don't think his credit is going to get where it needs to be to get the best rate, and you qualify on your own, a lot of people do buy it on their own, and then they just figure out some sort of agreement after with holding title and what will happen when you sell the property.
Oh, okay.
Yeah, and then I can give you, and I'm sure Jennifer can too, different ways that people that are not married have done that. And then, though, if he wants to work on the credit, I don't know if it's collections or just high debt or whatever it is, judgments, whatever. But if you think you're going to be buying in the next year, I would say at least 6 months before, talk to a mortgage professional, get it pulled, and then start to figure out what you need to do to get mortgage ready.
Okay, cool.
Yeah, lenders are super resourceful when it comes to getting you ready, and having that initial conversation of, okay, this is my situation, this is my partner's situation, and having them tell you, okay, well, if you want to buy together, this is what you need to do, and they can help with all kinds of things, including rescoring, right, Erica? So if you have stuff that shouldn't be on that credit score or whatever, they can help get that off.
Yeah, and then we have something inside Fairway that's called Credit Tool, and it's a free analyzer. Now, it's not a credit repair company, but it is its own division within Fairway. And so when we pull credit and we're not where you want to be, or you don't qualify, then we can pull analyzers. They help you come up with the plan. You have to do the work, but they stay in touch with you and they put you on a timeline. So that's free. And, but you just have to do the work, but they guide you along the way. And then if it's something where you're like, I don't want to do the work, I don't want to write these letters, I don't want to, I just want somebody to fix it. We, put you outside of Fairway into a credit repair company that we work with.
Oh, okay. Cool.
And the free tool, is that something you just sign up for, or what is that?
Yeah, so when we pull credit and we go over it with you and we say, well, you're at a 680, but this analyzer says you can get to 700 pretty quickly. You just sign a release that allows them to view your credit report and work with you on that plan.
Okay, got it.
Yeah, and it's just charged to our branch. We don't pass it on to the customer.
Okay,
yeah.
Excellent.
Cool.
All right. Well, I'm going to stop sharing my screen here, and I'll stop the